What if you could instantly own fractions of 500 major tech and retail companies, all at once, for just $1? You can do exactly that through the S&P 500, which stands for Standard & Poor's 500. Because of its broad exposure, many financial advisors treat this index as a primary building block for long-term retirement accounts. By the end of this video, you are going to execute a live trade and officially own a piece of it. To get this done, you only need two things: an internet connection and a linked bank account. Direct market participation used to be gate-kept by Wall Street institutions. Today, you can bypass those middlemen and build a portfolio directly from your smartphone. The S&P 500 is essentially the scoreboard of American business. It's a constantly updating list of the 500 largest publicly traded companies in the United States. This index includes early technological pioneers like Apple, which currently makes up about 7% of the list, because the entire index is weighted by market cap. It also holds modern software giants like Microsoft and Google, which carry massive weight in determining whether the overall market moves up or down. And the rest of the list is stabilized by foundational financial institutions like JP Morgan and Visa. This basket structure gives you instant diversification. If one company goes bankrupt, it barely moves the needle because you still hold 499 others. You are not betting on a single CEO's performance or a single product launch. You are making a mathematical bet on the overall survival of the American economy. Since its modern inception in 1957, the S&P 500 has returned an average of about 10.5% per year. This chart shows the macroeconomic timeline of that growth. Over a half-century, that average keeps climbing through recessions, wars, and pandemics. Yes, there are severe individual years. In 2008, the market dropped 38%. In 2020, it briefly dropped 34%. But look at the data 5 or 10 years later. Every single time, the market recovered those exact losses and went higher. To buy in, you can choose an index fund, which buys fractional shares for a specific dollar amount. Good options are FNILX or VIFIAX. Or you can choose an ETF, which trades like a stock. Options like SPY or VU. The historical data clearly proves that short-term portfolio volatility is simply an unavoidable phase of your long-term wealth generation. Let's execute the trade. Step 1 is to open an account with a major firm like Fidelity, Vanguard, or Schwab and link your primary bank account. Be careful to avoid the cash trap. Transferring money to your brokerage account does not mean you have invested it yet. Locate the search function. Type your ticker like FNILX and select Buy. Enter the amount and hit Submit. A green screen confirms Order Executed. Crossing the threshold from a consumer to an investor requires zero complex financial modeling, only basic digital navigation. Now that you know how to make that initial $1 investment, we need to look at what happens when you make consistent monthly contributions over decades. Investing $300 monthly in the S&P 500 yields $678,000 after 30 years. You contributed just $108,000. The $570,000 remainder is compound growth. Start 10 years earlier, it becomes $1.9 million, a massive $1.2 million delta. To guarantee you stay on track, utilize the Auto Invest feature in your brokerage. This ensures your accumulation process runs every month, entirely independent of your willpower. If you have just completed your first trade, subscribe to the channel and comment below with the specific ticker symbol you purchased. Outsized wealth creation relies entirely on the mathematical advantage of starting immediately, rather than trying to time the market.